What's going on, everybody? Jeff here. Welcome back to the channel. Market not ready to roll over just yet. Buy the dip theme continues. Now, there's two things I want to talk about in this video. The first one is going to be very important, really over the next 6 weeks. I'm going to explain to you why. The second one is going to be piggybacked off of a tweet that I had sent out earlier today talking about a profitable setup. People reached out to me, so I want to break everything down for you guys. Let's get right into it. First off, as you can see, looked like the market wanted to charge right out of the gate, can kind of consolidate a little bit, and that late day charge not ready to roll over. Really just looks like we're consolidating for another leg higher. Now, while the first quarter of the year did wrap up with some nice gains, doesn't look like the hedge funds are ready to take some of those profits, especially in the tech sector. As you can see, some of these high growth stocks, such as Upstart that's on this list, Roblox, among some of the other tech, Nvidia, Meta as well, just continued to grind higher. Now let's talk about that news, okay? And this really ties into inflation, and especially because we just started the month of April, this is going to be very relevant for when April CPI numbers come out in the month of May. Now, if you're unaware, OPEC had announced a production cut, okay? And so as soon as this was priced in, futures had jumped for oil futures late Sunday. And as you can see, this massive gap right here, oil was trading at about $75, $76 a barrel, opened up somewhere around that 81 to 82 range, bounced off 79. And here we are standing at about $80 as of right now. To zoom out and give you guys a little bit bigger of a picture, we were much higher, going all the way back towards that April-May timeframe. Really sold off, got down to as low as $64 a barrel, and here we are charging back. Now, the reason why oil had sold off, there's a couple different reasons for that, but one of the big reasons is because energy tends to front run a potential recession, okay? And so when, some analysts are looking at the potential for recession, they're not only focusing heavily on the bond market, what the bond market is predicting, but also what the energy sector is. They tend to really sell off when there's a potential for a recession indicated, and that's exactly what happened with the oil. But as you can see, guys, all the way back in March, we were sitting at around, between 60, let's say $70 to $75 on average for a barrel of oil, which is going to be, reflected when the March CPI numbers come out in just a few weeks. But what is the potential if this continues to run? Now, this article says right here, obviously oil prices on track for the biggest gain in nearly a year after OPEC's surprise output cut. Doing this for a couple of reasons, guys. OPEC doesn't matter really what any article says or what the media says. In reality, they control the supply and the demand. When they see demand slowing down, they will cut the supply in order to raise prices. They do this for a multitude of reasons, but inevitably it all comes down to profit, guys, okay? But analysts are expecting and saying that, listen, this can get back up to $100 a barrel very easily, okay? Especially with the amount that they're cutting. Now, we did jump a little bit. We got to that 80, 81, 82, and 81 and a half. Kind of sold off a little bit, continue to consolidate. It'll take some time, just to see exactly how high this wants to go. If you look at some of, the top two stocks I have on my list that ran the most today for the percentage change, it's ExxonMobil and Occidental Petroleum, both just ripping. ExxonMobil came right out of the gate, held that 113 and continued to move higher all day long. So keep a close eye on it. Like I said, why this is very important, because first of all, we're at the start of April, okay? We can monitor this all month to get a really good gauge on what inflation might potentially come in when it comes to the month of May. We've been talking about this when it comes to rate cuts, the Federal Reserve, banks are under a lot of stress as of right now. And by the looks at, you take a look at QQQ and you take a look at the entire, just the individual tech stocks, they're rallying as if, listen, high growth is the way to go, okay, right now. They're going to be cutting interest rates. We've started to hit a peak, and it's seen a massive rally comparatively to other stocks in the sector. So just keep an eye on that. Now, this is what I had tweeted earlier. It was a setup. I said prime setup. We coded in the algo. I have created an algo. I'm sure many of you guys know this as of right now. By me creating it, what I mean is one of my partners who is really a great website developer. We've done a lot of work over the past 5 or 6 years, especially, you know, in the marketing industry. I've pulled away from a lot over the past couple of years. And I had him who knows nothing about trading. I said, listen, these are my setups. This is what I want to happen. Can you code this? There's been a lot of back and forth because he really doesn't understand trading whatsoever. But this is something that we had coded into the system, right? When the market gaps down, it shows a tight range. It shows weakness once there's a break of that pre-market low to be able to signal that short. Now let's talk a little bit about this, guys, just to give you a better understanding of why this setup exists and a little bit of the criteria behind this. So whether you're going to, you know, eventually utilize this when I share this algo, or you're just looking to get a little bit better insight for yourself, a couple things. One, when you're looking to play the opening range break, which this short was signaled at a candle close, showing we immediately broke that. When you're looking to play the opening range breakout, okay, two things to look for, whether it's gap up or gap down. In this case, Tesla gap down, as you can see from where it closed to where it had opened up in pre-market. This is trading view, so it opens up at 7 o'clock in the morning, and it had gap down. Reason being is Q1 deliveries had come out. Tesla always does run up into their deliveries numbers. Very common for it to happen. And then the numbers were great when it comes to year over year, comparing Q1 of 2022. However, they were a little bit less than expectations, especially because they had cut their prices. I think, you know, analysts were expecting the number just be a little bit higher, and naturally it sold off. Two things you want to look for. One is a gap up or a gap down, whether you're playing the upside or in this case gap down to the downside. And I also like to see a tight range, right? You're not seeing these massive swing high, swing low, you know, where it's moving very, very wild. Now Tesla, the high on this was 201.80 and the low is 199.80. That is in a 1% range. Okay. Now, if you were trading a stock that was, say, you know, $50, I probably wouldn't, you know, calculate a $2 move as a tight range. But given Tesla's volatility, given Tesla's, you know, price and their float, a 1% move is very, very normal. If you don't like to play the opening range breakout, okay, which is another phenomenal trade that I like to take, which is the break and the retest, which is when this, you know, it opens up, it kind of bounces around a little bit, it breaks that pre-market high or pre-market low, and then it goes back to retest it, right? So in this case, it would be this old support that broke that would wants to confirm old support would be new resistance. Now, not every break retest, as you can clearly see right here, once we broke that level, we never had touched it again. And that's okay. You have to understand your risk tolerance and just be okay missing out on some of the plays. Given, you know, the fact that we gapped down, and given, you know, just knowing what had the news behind this, okay, and how Tesla tends to trade, I was very comfortable taking this trade. I did not get into it right away. I kind of scaled into it, and I added a little bit to my position back over here. All right, I did scale out of it as the algo did look like it was trying to base around this 194, which does have previous support going back on larger time frames. This is another beautiful thing I love about coding this, guys, is there's no bias when it comes to computers. Okay, very quickly it had a long signal once it based, and it showed to bounce off of this, kind of had a tiny little ride up, got another signal, so it was added confirmation. You could see that we broke through this 195 level, retested it, now it held. All right, broke through and it held as support once again. It couldn't happen. Once it couldn't happen over a set criteria of time, you need to understand when you're not in a position that's going with you, right? So I had immediately exited this position. I did not take it to the short side. I just exited this position. And here's the thing, guys. If it moved all the way back up to, let's say, $200, okay, even though the entire market did recover towards the end of the day, I would have been okay with it, because the point behind all of this, okay, and this was the number one thing I had stressed to the coder, was that we need to keep our losses short, right? And this technically wasn't even a loss because I had kind of scalped it a little bit. I scalped it a little bit first, and I had added back into it. Okay, but inevitably, even this you would calculate this as a break even. Even if it was a loss, if you had taken this little trade and had gotten out of it once it broke that 195, your loss would have been so small. It's all about maximizing your winners and minimizing your losers. One thing that not only I have seen time and time again, but I am starting to see even more lately as people have been reaching out to me, and I'm trying to focus a little bit more on helping people as I'm not, you know, actively day trading the screens, you know, 8 hours a day because of my newborn. Okay, is that you're seeing people that have a win rate greater than 50%. And I'm talking like 65, 70% win rate but they're negative, and it's because they're scalping some of their winners. They're focusing too much on their P&L when they're trying to get out of their winners. They're getting out of them a little bit too quickly, or they're just scalping the setup when as soon as it works and not letting it fully play through. But they have no problem holding on to their losers. Okay, so guys, I hope this video helps you. Take a look at this chart. You can backtest it. You can run the replay. That's it for this video, guys. I'll see you in the next one.